Thanks for joining us here on The Open. I'm John Orlipin. What a month. This has been a pretty volatile October for investors, to say the least. For more on how strategists have been navigating these waters, let's check in with Sam Stovall, who's the Chief Investment Strategist at CFRA Research, joining us from New York. What say you, Mr. Stovall? How's this month been on your end?
Good morning, John. Well, certainly this month has been no different than what people would expect from the month in which Halloween falls. Interesting is that October is by far the worst month in terms of average volatility, in terms of 1% moves, and so we're getting that. Typically what we see is weakness in the second and third quarters of midterm election years. That did not happen this time, so it all seems to be concentrated in the month of October, and those sectors that were the leaders up to the September 20th high are the ones that are taking the beating, because that's where the profits can be found.
Yeah, and so some people will say, well, this is a healthy thing, you know, this is normal, all these stocks had big run-ups, of course you would see a sell-off, but then you've got another school of people who say, oh, this is it, bull market is done. Where do you weigh in?
Well, I think you have to have that kind of disagreement, because if everybody felt that this was just a dip to buy into, we wouldn't have the dip. So I'm of the belief that we do end up seeing a lower print when all is said and done. I'm expecting to see a decline to about, the low 2,500 area on the S&P 500, which would represent about a 14% decline. Your typical correction going back to World War II, this is the 26th year since World War II that we have seen at least two declines of 5% or more in the same calendar year. And about 70% of the time, that second decline tends to be deeper than the first one.
Okay, and so I guess for those who are wondering if this is time to exit stocks that have been high flyers, maybe get a little more bond exposure in your portfolio, this is it. Longer term, what do you think the outlook is for the stock market?
Because I'm not that nimble to say get out this week, get back in next week. I'm telling advisors that you're really better off buying than you are bailing, reminding them that diversification did not fail us in 2008, and that actually a 60-40 portfolio did better in 08 than it did in the mid-70s or obviously in the Great Depression. So you can just see it in terms of the rotation into the safer haven treasuries when markets sell off. There's an old saying that from worst to first, or in New York, it's from waist to foist. But usually it's those industries that were beaten up the most that tend to be the best performers when the market does finally recover.
So, the story that seems to be helping stock futures today is the interview that the president did with Fox News, where he talked about the optimism he has for a possible deal between the U.S. and China. We know that's been one of the overhangs on the market. A lot of people had started to zero in on the fact that we hadn't heard the president tweeting about the stock market this month during the downswing. Until now, we just got a president, the president just tweeted saying that the market is up massively since the election, i.e. his election, but is now taking a little pause. People want to see what happens in the midterms. If you want your stocks to go down, I strongly suggest voting Democrat. They like the Venezuela financial model, high taxes, and open borders. So the president sort of expanding on something that we heard from one of his key economic advisors, Larry Kudlow, who early on during this selling pressure said, well, the reason stocks are down is because Democrats might have some key wins on November 6th. What's your reaction to that tweet?
Well, my feeling is that the market is responding right now to PEs, politics and earnings. Politics, certainly from the trade perspective, as you just mentioned, with the G20 meeting scheduled for the end of November, I think that there's a hope that we end up having some sort of negotiations be renewed once again. We also have the midterm elections earlier in November, and as I had mentioned before, historically the market does not do well because the party in power tends to lose an average of 22 seats. If the Republicans lose 23 seats, then the Democrats take control. But you know, the pollsters could always be wrong, as they were in the presidential election and as they were in Brexit. So maybe the Republicans don't lose control. History says you don't want a divided Congress. A Republican president and a divided Congress since 1900 provided the lowest average annual increase of any governmental scenario. So I think gridlock is not good when it comes to the stock market. So right now I think investors are also waiting to hear what the Fed has to say when they meet in December. Expectations are that they might scale back their hawkish tone, and I think investors would be very much relieved to hear that.
Right, but I just got to come back to this tweet again. I mean, for the president to say, if you want your stocks to go down, I strongly suggest voting Democrat. As a Wall Street participant, what do you make of the president making a comment like that?
I regard that as simply being politics as usual, that, you know, if you want something to go your way, you're going to try to paint it in the gloomiest picture possible should that not occur. So I don't think people are really looking at that tweet and being taken in by it. Those who would are probably not sophisticated investors and probably aren't investors at all. So I would tend to say that investors are focusing more on the technicals right now, looking towards support levels, realizing that seasonally we are in actually the best period of the 16-quarter presidential cycle, the coming 6-month period, and the 12 months, October 31 through October 31. And so I would tend to say that investors are looking for that level at which to buy back in.
Sam, we only have about 30 seconds left, but you know, it's worth pointing out that we're near correction territory for not just U.S. stocks or Canadian stocks, but in Europe and Japan and Shanghai and Hong Kong and Argentina. It's been a really tough stretch. Now, in 2017, we talked about a synchronized pickup in markets, a global economy that seemed to be gaining ground. When you say you feel like the long-term strategy is to buy stocks, is that across the board?
I think that when you're looking toward earnings growth, the better growth potential is overseas. Looking at the S&P BMI, meaning Broad Market Index, the developed indices, we're looking for about 5% growth this year, but closer to 9% growth next year. And when you look at the emerging markets, we're looking for 7% this year, then rising to about 14% next year. So really the growth potential is found overseas, whereas we expect earnings to be cut in half here in the States in 2019.
All right, Sam, always good to get your take. Thanks so much. Appreciate it.
My pleasure, John.
Sam Stovall, Chief Investment Strategist at CFRA Research, joining us from New York. We got a lot coming up.